Alright, then we're going to go ahead and get started. I want to thank everybody for coming tonight. I want to welcome you to tonight's webinar. We're going to be discussing and talking about one of my favorite strategies actually, and that is a way to scalp crude using value bars and MQ momentum. Then I'll also show you a couple different ways to use additional indicators in order to potentially lower your risk with the trading and find even better entries. As you know, if you're part of the trading room, we normally try to have really good reward to risk ratios, meaning we're earning or our profits are 2, 3, 5, 10 times larger than what our risk is with our stop loss. We normally try to risk no more than about $200 a contract on any trade. Granted, we do occasionally risk more than that, but we normally try to keep it under $200 a contract when trading futures. And with this, you're only risking around $50 to a maximum of $100 a contract when you're scalping. And your profit targets are anywhere from 10 pips to 20 or 30 or 40 pips. You can actually get into some really big moves by using the scalping strategy and catch them. You have to be paying attention. You have to be very quick on the draw with getting in and out of positions, though, and moving your stop losses. And I'll show you a little bit later how to do that with TradeStation anyway. I'm not sure if there's ways to do it with NinjaTrader or the other platforms that many of you use. So we'll go ahead and get in. If you have any questions at any time throughout today's presentation, feel free to submit it via the GoToWebinar side menu. At the end, I'll try to answer them. We'll also do some questions during a live part where I'm going to pull up my TradeStation screen. And we'll look at crude, and we can actually look at the markets today and where the trading opportunities were there for scalping this way and how it would have worked out, because I want you to know that I didn't just go and cherry pick examples when I'm showing the actual webinar or the actual slideshow. Now, before we actually start, there's a couple things I need to point out, and I do this at every webinar, any different strategy that we use, and that's the three components of technical analysis. And I always say that you need to be aware of and take into consideration all three components before you place any trade. Now, those are price, momentum, and value. Now, traditional price charts are what technical analysts have used for the past 100 years or so to display price, and that's just the cost of the market plotted on a graph. Well, we also have indicators now that can display momentum, such as the MQ momentum indicator, your stochastics, other oscillators like that. And then we now, with value charts, and more specifically value bars, which we'll be using in today's strategy, we have a way to display objective value. And the key word here is objective value. We've always had subjective value in the markets, which is just normally just an analyst's opinion. They believe the market is going to be heading higher. They believe it's undervalued, or they believe it's overvalued. Well, by using value charts, we're able to find a way to objectively plot the value based off of historical price data. So there's no opinions or human error involved. Again, the indicators we're going to be using tonight, value charts, more specifically value bars, and then MQ momentum. I'll also pull up the cycle finder and MQ regression later on. Now, what are value charts and how do they help us? And more specifically, what are value bars and how are they going to help us? What value charts do is they plot price in terms of value in one of 5 color-coded valuation zones, ranging from the center green area, which is considered fair value. Above and below that, we have the yellow area, which is moderately overvalued and moderately undervalued, respectively. And then above and below that, we have the red area, which is significantly overvalued and significantly undervalued. Now, historically speaking, this is just a rough average, and this does change depending on the market you're looking at and the settings you have with your value charts. But roughly speaking, about 66% of all trading activity takes place in this fair value zone, with about 16% of all trading activity taking place in moderately overvalued and moderately undervalued price zones, and then only about 1 to 2.5% of trading activity takes place in the significantly overvalued and significantly undervalued price zones. So you know the market very rarely trades within those price levels. Now, what value bars are is they're this value chart superimposed over top of a traditional open high-low close chart. So you can see the lower red or significantly undervalued price means the lower red area corresponds to the lower red area on your open, high, low, close chart. The lower yellow area, again, moderately undervalued, is the lower yellow on your open, high, low, close chart. Green is fair value, upper yellow, moderately overvalued, upper red, significantly overvalued. So it just superimposes, it gives us another way to see cost and value at the same time. Now what does MQ momentum do and how does this help us? Well, what momentum does, what the MQ momentum indicator does, is it attempts to help us plot the momentum of a market or the strength that a market has when it's moving in one direction or the other. It's similar to how a moving average convergence divergence works, but this is actually a proprietary indicator that Mark Helwig himself designed, taking bits and pieces of his favorite momentum indicators and making basically a hybrid that pulled off all the key uses that he liked the most out of all those indicators. So as you can see, you have your indicator line, which is the blue line. Then you have your lagged indicator line or trailing indicator line, which is the dotted line. Then you have your histogram, which shows the spread between the two indicator lines. And the way that we're going to trade the markets is by trading these divergences for crude, which happen all the time intraday on 1, 2, and 5 minute charts. And we'll be trading divergences on both histogram and divergences on the indicator line. Now the reason you have to be fast with this strategy is because the market's only going to give you the opportunity to get in. You want to be getting in at a specific price level, but you're only going to have a split second usually to get in there, place your stop, and then have the market move in your direction. And the difference between getting in at the correct value level and not getting in at the correct value level is the difference between having a profitable trade and a not profitable trade. And I'll explain what I mean by that later. There's a few different rules we need to follow when trading a strategy, and these are very similar on every strategy that I explain because I believe that they're needed for any type of trading that you're doing. And the first rule, as always, is always have proper stop losses. You want to, whether that's a mental stop or a hard stop, it doesn't matter, but you need to have a reason or a way for you to get out. You don't want to have the market run against you and just turn what was once just a small loss into a huge loss. The second rule, you don't want to rush your trades. Let the trade come to you. Think of trading as your job, and you're getting paid to be patient and wait for the market to give you these proper opportunities to trade. So you want to take your time, let the market develop, let the trends develop, let the signs develop that give you a good trade opportunity, and then pounce on that great trade opportunity instead of trying to force a trade. The third rule, have scalping targets. If you're trading, this is for the scalping only, but if you're trading trying to scalp the market, I know I said you can catch larger trends, but have realistic expectations. You're scalping, which means you're trying to take anywhere from 5 to 15 ticks out at a time. You can catch bigger moves, and I'll explain to you how to do that later, but if you're trying to just get in and out of the market and literally scalp it, then you need to make sure that you have expectations of moving your stop to break even when you're very close to your target, instead of trying to leave your stop below it and then have losing trade with just small, tiny losses at a time. And then the last rule is make sure you stick to the strategy. If you're not sticking to the strategy, obviously it won't work for you. Now, how do you trade this strategy? First off, what is scalping? Scalping is basically trading intraday price swings for a very short period of time, anywhere from 1 or 2 minutes all the way up to 10 minutes to an hour at the most. It's very, very micro day trading is what I call it. How much are we risking per trade? As I mentioned before, we're really only risking 5 to 10 at the most ticks in crude. So that's anywhere from $50 to $100 per contract. We're not risking very much. Even risking 10 is pushing it a lot of times. Because of the way that we're going to be timing our entries, we really shouldn't have to risk a very large amount of money with our stop loss. What gives you the signal? What gives us a trade signal? There's a couple different things we'll look for. We will look for, there's aggressive entries we can use, and then there's more conservative entries that we can use where we're actually waiting for momentum to roll over before we get in. The aggressive way, and I'll explain all this as soon as we start pulling up charts and I can show it to you, But you're looking for, again, divergences. Now, what is a divergence? Divergence is when the market or the price continues to go further in one direction while the indicator goes in the opposite direction. So you have lower prices but a higher indicator. So while your prices are continuing to go down, your indicator is starting to roll over and start heading higher. Or vice versa, the market's continuing to go higher but your indicator is starting to roll over and go lower. So they diverge, they go opposite directions. When do you exit? You're going to exit or move your stop to break even as soon as you hit a value target. So if you're getting in long at undervalued, then you're going to be exiting or moving your stop to break even at overvalued. Does this strategy only work for crude? No, it doesn't only work for crude. You can use it basically on any market there is. One thing I will point out, though, is you want to make sure you're trading in a liquid market, especially if you're trying to scalp. Because if you're trading something like RBOB or heating oil in off hours, where as soon as you get in, it's actually going to make the market, if you're only trading 1 or 2 contracts, it's going to make the market jump 2, 4, or 5 ticks. What looked like a good trade no longer looks like a good trade, and now you have a losing trade. So you want to make sure you're trading very liquid markets such as gold, crude, soy, anything like that, the S&Ps. But you can use it on different markets. Today we're just going to be focusing on crude oil, however. So I'll give you a few examples and show you what divergences are, and then we're going to roll over, pull up TradeStation, and we'll actually look for some that happened today, how you could have traded those today, and then also yesterday as well, because like I said, I want you to know that I'm not just cherry picking these trades, that they actually happen on a daily basis. The best time, in my opinion, to trade them is during the peak hours, which is what I consider the peak hours anyway, which is about 6 a.m. Eastern time until about noon, maybe 1 o'clock Eastern time. So you have about a 6-7 hour period where there's really high volume, the markets move quite a bit, and you get some really great trading opportunities. Now, again, what is a divergence? This is what I mean by divergence. You can see the prices, they're coming higher. We came all the way up, we had equally high prices. So it doesn't necessarily have to be a higher price. It can be an equally high price. I normally look for it to be within 1 or 2 ticks of the previous high. So we had upward momentum. You see our momentum indicator climbing, 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 climbing. The market's pulled back a little bit and then rallied, went right back up, retested that same equal high. But if you look at our indicator, instead of the indicators coming back up, we had a lower indicator high. So we went from there down to here. And then if you look at the histogram, it's even more obvious. The indicator rolled from upside momentum down to downside momentum, so we had an increase in downward momentum compared to the previous downside momentum. So we had more downside momentum, and then you look at the histogram again. On this next rally, we came right back up equally high prices, but we had a lower high on the histogram as well. Now the stronger signals are when you have lower highs or higher highs, the divergences on both the indicator line, which are these two blue line, this blue line and the dotted line, and the histogram. As soon as you have that, you have the okay to get short. Again, you hit significantly overvalued prices, that upper red portion. So you had the equally high prices and you had significantly overvalued. So you know the market only trades significantly overvalued for a very, very small period of time, roughly 1, at the most 2.5% of the time. So you're getting short at that equally high, you're risking 5 ticks beyond it. And then as soon as this market rolls over and you hit undervalued here, you're either taking partial profit or taking full profit. If you're trying to be aggressive and catch this entire move, if you believe the market's going to continue to roll over, what you do is you move your stop to break even. Okay, so you have the divergence, equally high prices, lower high indicator. So you have the okay to get short. That means the market's losing strength. As you can see, it rolled over, sold off from 96.35 all the way down to an ultimate low of 96.07 roughly. Now, the reason you absolutely would have exited here is because you had a buy signal. You're looking to reverse your position. So you just took about 30 ticks to the downside. Let's say a little bit less. Let's say you took about 20 ticks. Your fills weren't great. So you took about 20 ticks off to the downside. Now you have a bullish divergence. The first one was a bearish divergence, meaning the prices are looking like they're going to head lower. The next one is a bullish divergence. And the reason this is a bullish divergence, you see, we had the first low here in prices. You look at your momentum histogram, all the way down, you had a very long bottom in that momentum histogram. If you look at the upside momentum, it came up right here. So you had a little bit higher, a greater upside momentum than the previous upside. It doesn't always have to happen that way. This is just the perfect setup, basically. And then you came down and you had even lower prices. So you had lower prices, but if you look at your histogram, your downside momentum significantly higher than the previous low. And then if you look right here, your indicator line was also higher, or just about the exact same. Ends up being a great trade, so you have the okay to go ahead and get long at the undervalued price. Again, you would have been getting long at the open of this bar, okay? The reason you get long at the open of this bar and not on this bar here, even though it's undervalued, you're not 100% sure when that market's going to stop. But you had this market come down, and on this bar right here, it stalled. The market opened and then closed right next to itself. So you had a doji, which shows indecision in the market. That means the market's stalling, so you have the okay to go ahead and buy. So you buy on the open of this bar and with risking the low, which is just a few ticks. If you want to be more aggressive, you can risk a couple ticks below, which is what I normally do personally. I risk a few ticks below the low. That gives the market the ability to come down, touch that low, and continue higher. This, like I said, this is just a perfect example. It came down, you had the stall, you get long on the open of the next bar. This market took off all the way back up to the highs where you had a bearish divergence, although it's just a slight bearish divergence, not as good of a bearish divergence as we had before. And then you can go ahead and exit here, or you could have held it, tried to catch a longer term swing to the upside. But again, then you took another 20 to potentially 30 ticks out to the upside. So in a matter of an hour, you took about 60 ticks or so out of crude, which is a great trade. You were only risking 5 ticks per entry. Now, where does your stop loss go? How do you decide when you're going to place your stop loss, where you're going to place your stop loss? Again, this is on a 1-minute chart, as you can see. We're looking for the divergence. So here we go. We have the markets coming higher. We see it came up and then it fell and then rallied up again. You see the momentum increased from the previous low. So there is the first momentum down. Here's the second momentum downswing. And you can see the downside momentum has started to increase. We came back up, hit significantly overvalued once again. That's that upper red bar portion. Significantly overvalued. We know it rarely trades in that area. We have the divergence. So we have lower indicator highs. Here's the first high. Here's the second high. Again, your histogram. Here's the first high. Here's the second high. Significantly overvalued, higher prices. So you have the okay to get short at the significantly overvalued level. You have your stop, again, 5 ticks beyond the high. And then you let this market play out. You let it trend down. As soon as you hit undervalued here, there's your first profit target for either half profit or for full profit if you want to be very conservative. If you want to be more aggressive and try to catch a longer trade, a longer term swing to the low, so you're thinking the crude oil market overall is going to be heading lower and you think you just found a great entry point to catch that entire move down, then you can move your stop to break even where your entry was. Now, like I said, you have to be very, very quick on the draw with placing these trades and with placing your stop losses, because it literally will stay in that significantly overvalued price point when you have these great divergences like this for a couple seconds at the most. Occasionally you'll get it stay there for 30 seconds or so, but really you have to be watching it, you have to be focused on what you're doing, and as soon as it gets there, you have the short, you have to be paying attention to your indicators, to the value levels, and to your momentum. You have the okay to get short, you have your automatically placed stop loss. I normally have my stop loss auto place about 10 ticks away, and then I drag it down with chart trading on TradeStation, which I'll show you how to do that once we switch over to TradeStation. And that allows me to get in with my stop loss very quickly and catch the divergence to the downside. The next example, this is just an example of how many trades you can get in a time frame. And all these arrows are buy and sell signals, and they're all divergences, and I'll explain why each one is a buy or a sell. This first one, you have a down arrow, so you have a sell signal here. You're moderately overvalued. you're within 2 ticks of the previous high. Remember I said look for the within 2 ticks of the previous high. Your market stalled right there on that arrow. It came up, it was moderately overvalued, and then closed right next to the open, so it stalled, shows indecision. With this trade, you place your stop 1 or 2 ticks beyond the previous high, which is still only about 5 ticks total. It could be even less, maybe about 4 ticks. You want it 1 or 2 ticks beyond this previous high because that's going to be your 1-minute resistance. If you look at your indicators, you see the first rally, we had a pretty big upsurge in the momentum. The second rally, significantly lower on the indicator line and on the histogram. So we had lower highs on the indicator line and on the histogram. We had just about equally high highs within 2 ticks. So we have the okay to go ahead and short. As soon as it hits undervalued, you either take profits or you move your stop to break even. If you get break even, you're still in good shape. This market continues to sell off all the way down until you have a bullish divergence. Now you had the bullish divergence. We had this first sell off here. And you look at your histogram, came all the way down to these lows and then back up. Then you had your second sell off. Came all the way down, significantly undervalued, so you had lower prices and you were significantly undervalued, which is what you're looking for to get long. But if you look at your histogram, you had a higher histogram low than this previous down swing. So you had the okay to buy at that significantly undervalued price. You're risking, again, automatic stop loss 5 to 10 ticks away. This market immediately turned around and rallied straight up. So you went from 96.20 just about. If you got in at the low, you got in at about 96.12, all the way up to a high of 96.50. So about another 30 tick swing to the upside. Great trade. Now at the upside, you had a bearish divergence. These are not great divergences like we had before. The better divergences are when you have both the indicator line and the histogram, like this first one. This one you can see is just a histogram divergence. The indicator line actually continued lower. Same with this divergence here. Higher prices, but the histogram was lower compared to the previous rally, although the indicator line was higher. So I put more weight when I have both the indicator and the histogram at the same time. That's a better signal in my opinion. But you can trade more aggressively for more signals by just trading the histogram divergences, and you will get a lot more signals that way, but you'll also have a lot more signals that aren't as good of signals for buys or sells. So you had a short here, again significantly overvalued. You hit that significantly overvalued price, but your indicator was significantly lower. So you have the okay to get short. Again, stop 5 ticks above the high. It rolled over. As soon as it hits moderately undervalued, you're either taking partial profit or you are moving your stop to break even if you want to try to catch a longer swing to the downside. Now this is where the timing comes in play, because if you had moved your stop to break even and you had a fill all the way up here in the significantly overvalued price range, then you were okay through this entire move to the downside. You wouldn't have gotten stopped out on this last rally before it took off. And crude does do that quite often. Before it runs in one direction or the other, it'll spike low or spike high and run the stops really quick within a minute or two. As you can see, this is a 1-minute chart. In 2 minutes, it went up from 40 all the way up to 55, so 15 ticks roughly, and then turned right back around and fell within the next 20 minutes all the way down almost 40 ticks. So again, it just ran the stops out and then took off. Here, again, you had another sell signal. If you were still in it from before, you're still in good shape. If you were in it, if you had taken your profits at significantly undervalued or moderately undervalued, then you had the okay to go ahead and get short again here. The reason you have the okay to get short here, the market pulled a significant distance away from this 8 exponential moving average. I call this the gravity line because the markets, no matter what market you're looking at, likes to trade close to an 8 exponential moving average. Don't ask me why, it's just how it happens. So you see the market spiked way away from that 8 exponential moving average, same way that it did over here, pulled a significant distance away from the 8 EMA, and then it immediately turned. So you had that spike, your momentum had steadily been decreasing, it ran the stops. You also have to be aware that crude runs stops like this, like I said, So if it starts to fall like this, even if you don't get in at the overvalued price point like that, but you see it run the stops all the way up and then immediately reverse on the very next bar, then it looks like, and oftentimes it's going to be a great trade even if you get in fair value. So even if you get in down here, you still have the ability to take almost 30 ticks out to the downside, all the way down to the low. We actually had, I missed a signal right here. I didn't show it on, didn't put an arrow on it. We had a bullish divergence, lower low prices, higher low indicator histogram compared to the previous low, and then higher low or equally low indicator line. And then it rallied right up from there. So again, you hit moderately overvalued, stop goes to break even. No matter what, as soon as you hit the opposing value level, your stop goes break even. Okay, that's what's going to save you from having the market, you're getting in on a scalp, you're hitting the opposing value level, which is technically supposed to be your profit target because you're scalping. You're only trying to take a few ticks out at a time. If you're trying to catch longer moves, which is what I typically try to do, I always move my stop to break even as soon as I hit the opposing value level, because that means we've hit an opposite extreme and the market could rally back in our direction. So as soon as you hit the opposing value level, stop goes break even. It came all the way back down. If you didn't exit here, you got stopped out at break even, but you had another buy signal, significantly undervalued, equally low prices. So you had your support level from the previous low, significantly undervalued, higher low indicator line. Here's an example where the histogram was slightly lower than the previous low, but your indicator line was higher. As I said, you can trade either the divergence on the indicator line or the histogram. The stronger is when you have both the indicator line and the histogram together, both showing the divergence. So you have the buy signal, you get long. As soon as you hit overvalued, you're either taking profits or a break even stop. As soon as you have the bearish divergence in the opposite direction, so you can see here, here's the first rally, and I'll point that out here. So rally 1, and then here's rally 2. Market came back up, hit new highs. After coming down and having a down period, hit new highs, started to roll over. As soon as you see the market stall, which is this bar right here, it's not a perfect doji, but the market came up and basically stopped. It rallied up and then pulled right back down, closed just within a couple ticks of the open of that bar. So you have the okay to go ahead and get short. Immediately you were in the money. The market did spike back up and try to run your stop out, which is why you have a 5-tick stop loss beyond the high. So if the high is here, 5 ticks is going to be right about up here. So you didn't get stopped out when the market spiked up and ran the stops. And then again, it tanked, fell right over. As soon as you hit undervalued, stop goes break even. It ended up falling all the way down, significantly undervalued, and that would have been your profit target. Normally, as soon as the market hits the significantly under or overvalued, I'm at least taking half profit off. And then if I think the market's going to continue in my direction, meaning I'm bullish crude, so I'm in a long position, I'll try to leave the second half one for a longer term swing trade. But almost 100% of the time, I'm out at the opposing significantly over or undervalued price level. So again, you had another great swing trade to the downside here. The market rallied back up. Your second or your last trading opportunity would have been this red arrow here. Again, you're within 2 to 3 ticks of that high because each square is 5 ticks. So you're about half a square away, so it's about 2.5 ticks, 3 ticks maybe. You have a significantly lower high MQ momentum, a lower high indicator line as well. You hit moderately overvalued, and then you stalled and came right back down, so you have the okay to get short. When it stalls like this, 2 bars in a row like this, you hit overvalued and you pulled back down to fair value. You hit overvalued again, pulled back down to fair value. You have the okay to go ahead and short at fair value, risking the high of your current bar. That's when the market looks like it just about hit the same high, where you're very close within a couple ticks. You have the okay to short in fair value, risking the high, which here that's 5 ticks, so you're risking $50 a contract. It ended up selling off. Again, as soon as it hits undervalued, your stop goes break even. It seems slightly complicated, I know, especially with all my scribble all over the screen. But this strategy, as long as you're paying attention, as long as you're quick on the draw and you know what you're looking for, can be very, very profitable. I know for those of you that were in Mark's commodity bull market workshop, this is what I was doing when we were talking, and in a matter of an hour or so, I was up around $600 trading one contract at a time. I was just doing these scalps, and I wasn't even catching the bigger moves. I had several entries where I could have had huge moves, taking 30 ticks or so out. I was getting out as soon as I hit the opposing value level, so I was just doing value range trading. Really quick scalps. I was only risking about $50 a contract, and like I said, in about an hour, I had taken out about $600 trading one contract, which was great. Like I said, this is one of my favorite strategies to use personally when I'm trading by myself, but you have to be very focused on what you're doing. We are going to try to trade it tomorrow in the live trading room, just so we can see how the strategy works, so people can get an example of it. I probably won't personally be trading. I'm not fast enough with explaining happening and placing the trades on the account, lose money trying to explain it all and trade it at the same time. The next example, this now longer, bigger gains. You take out a value range trade of 6 ticks. Value ranges to be to 10 ticks. You can just use a little bit longer time frame. You can use it on a 2-minute chart as well. Here's this first sell signal. Again, within 2 or 3 ticks of this high. You came right back up, overvalued. You stalled. You can see right there. Open and close right next to each other. You have the okay to get short with your stop at the high. It rolled over, hit significantly undervalued, which is your cover signal, or at least a break-even stop at a bare minimum. As soon as you hit significantly over or undervalued, your stop is going to break even. That would have been a great trade just there, 10 ticks to the downside that you could have taken out even if you entered in fair value. If you had been a little bit more patient and actually waited for it to come up into overvalued, you could have taken an additional 2 or 3 ticks. The next example we had, a bullish divergence here. Here's the first low. Here's the second low. Came right back down to test the same low. So we had at the exact same low, but if you look at our momentum indicator, we have a higher low on the indicator line and a higher low on the histogram line. So we have the okay, go ahead and buy. Again, risking, we're getting in at undervalued, remember, because we're right down at that equally low price and the indicator line is higher. If you want to be more conservative, you can actually wait until the indicator line starts ticking up. This doesn't work as well on 1-minute charts. It works better on 5-minute charts. But you can wait until the indicator line actually starts rolling over, which makes the divergence what I call confirmed, meaning the indicator has started heading back in the opposite direction, and it's confirmed that you have a higher low compared to the previous low. So you have the okay to get long, stop again 5 ticks below the low. As soon as you hit overvalued, stop goes break even. As soon as you hit significantly overvalued, you're having half profit. If you're bullish crude like we've been for the past 2 weeks, ever since it broke the weekly trend line, you can try to hold it for a longer term trade. Actually, I believe this trade here was just a couple days ago that we could have gotten in on. Actually, it might have been today or yesterday. But you could have caught this entire upside move until you saw the bearish divergence, and that says get out, get short, reverse the position or close the position, and that's here at this red arrow. We had significantly overvalued prices, a higher price, but a lower high compared to this previous rally. Now, this one's kind of tricky. It's not a perfect divergence. This is an extremely aggressive approach, this short right here. This is very aggressive. I personally wouldn't really take a short off of that. You do have a lower high compared to the previous rally, compared to the previous upsurge, and then you had the downswing, and now you're at significantly overvalued again, and your lower high. But you have the same thing that happened here, so I'd be very careful with that. That's why you have your tight stop, because that, I would have called that a divergence. You stalled, you had significantly overvalued prices, you had a lower high on your indicator line, you would have ended up getting stopped out at a 5-tick loss, or less, depending on how you traded it with how tight you had your stop loss, if you were risking the high, or if you're risking 2 ticks beyond the high, or if you were just risking 5 ticks. Here, again, it looked like it's picking up strength. It ended up rolling over and selling off about 15 ticks. But again, that's an extremely aggressive trade if you're trying to short that. This one here, the next buying opportunity, we came down equally low prices. We had a significantly undervalued price bar right there. I don't know if you can really see it. The screen's not that big, but it's significantly undervalued. You'll have to trust me. The market stalled again. Remember, open and close right next to each other. Even if you didn't get in at this significantly undervalued price, you had the stalled market and you had the higher low on your histogram. So you have the okay to go ahead and get long. Ended up rallying up. That's from roughly 96.42, went all the way up to almost 96.55. So another 10 ticks to the upside that way. Now, you can also do this on 5-minute charts. I'm trying to give you multiple time frames. The shorter the time frame, you'll have more signals. So 1, 2-minute, 3-minute charts, you'll have more signals. I personally never traded on a 3-minute chart, but I do know some traders that like trading on 3-minute charts. On a 5-minute chart, you're going to have more signals, or less signals, but you're going to have bigger price swings. This is what I was talking about when I said the markets really start picking up steam after 6 a.m. This is 6 a.m. right here, this line. And from about 6 to 1, the markets really start picking up volume. They start moving more. You get better signals, bigger price moves in your direction. And you can see it was really kind of choppy, just noise basically, which you can still trade. During the bull market workshop, that's what I was trading with the divergences, was noise. But I was trading value ranges, so I was immediately getting out at the opposing value level. Now, here's your first sell signal. This was actually a failed trade. You lost money on this trade, but again, that's what the very tight stop losses are for. Depending on how aggressive you were trading, you could have been out break even. You just about hit undervalued. You were just a few ticks above it. But it was a good trade in my opinion, so I wouldn't have been upset if I lost money there. If I lose money on what looks like a good signal, on something that I go back and I review, I look in my trade log and I say that was a good trade, everything was there, it just didn't play out, I'm not mad at myself, I'm not upset with losing money. You don't win every single trade. Any trader that tells you that they do is lying to you, and I would encourage you to run away as fast as possible. What we're trying to do is tilt the odds in our favor, give ourselves a higher probability with a better reward to risk ratio. So you lost 5 ticks here. The next trade, actually you would have lost less than that because you're risking the high, 2 ticks beyond the high, so you really would have lost 3 ticks, maybe 4 ticks. The next trade you have bearish divergence here, higher high prices compared to this previous overvalued price bar. You see it came up, hit overvalued, and then fell, then came up again, hit overvalued once more. If you look at the indicator line, lower highs. So the indicator line is slowly starting to pick up downside momentum. You also had lower lows on your downside. So you have the okay to go ahead and take the short, risking again the high, couple ticks beyond the high. The market ends up rolling over. As soon as you hit undervalued, right there, you go break even to try to catch a longer term swing trade, or you take profits. The next really good trading opportunity you had, you didn't have a divergence for several hours. You're, like I said, on a 5-minute chart, you're going to have less trades, but the winners are going to be bigger than what you have on the 1 and 2-minute charts. When I trade it, personally, I trade 1 and 2-minute trades. If I don't have any distractions at all, I'll trade on a 1-minute basis. If I have a little bit of distraction, I'll trade on a 2-minute chart. Here's your buy signal. You have this blue arrow, and this should have been blue as well. Reason, came back down equally low prices, or within 1 or 2 ticks, moderately undervalued, higher low indicator right there, and then higher low there compared to the previous low. So you have higher indicator lines and higher indicator histogram. The market also stalled. You can see the open and the close on that bar right next to each other. If you didn't get long at the support level, which is the previous lows, then you had the okay to get long at the open of the next bar, risking the low. So that would have been a risk of about 5 to 7 ticks. Like I said, you can risk all the way up to 10 ticks. I don't ever normally risk 10 ticks with this trading personally. Occasionally I'll risk 8 or so. This market rallied up. As soon as you hit significantly overvalued, you're already up almost 20 ticks, okay? Because each one of these squares, you're on a 5-minute chart, each one of these squares is 20 ticks. You're significantly overvalued. You got in at about 95, 85. If Current price is 96.05. So you're just about up 20 ticks. You have a lot of upside momentum. Stop goes break even. So your break even stop, half profit comes off at significantly overvalued. It's all right that the market continued to go higher. The reason it's all right is because you just took 20 ticks out of the market in a matter of 5 minutes. I'm happy with that. That's $200 a contract. That's why you have the second half and leave it on for the longer term swing trade. You leave it on until you have a reversal signal in the opposite direction on the same time frame. The first time we get a reversal signal is this red arrow. So you end up taking out from 95.85 all the way up to 96.80. So you took around 90 ticks depending on your fills with the second half of your contract. The reason you got short at this high, you can see here's the first rally. A huge upsurge in upside momentum. We came all the way back down, shifted to downside momentum, which was right here, and then we had another really big upsurge. But the indicators significantly lower. The histogram was significantly lower than the previous rally. The market ended up stalling right there on that bar. Open and close right next to each other. So you had a doji, so shows indecision. You also had lower high indicators. You're short, risking the high. Personally, that's a very, very large risk in my opinion. That's why I don't normally trade the 5-minute divergences unless I'm trading for a swing trade, and then I'm normally trading in the direction of the trend. So for this example, you're risking about, it's about 10, 12 ticks maybe, so about $120 a contract. It ended up rolling over and selling off all the way from the 96.80 area. You would have been in around 96.70. It sold off all the way down to 95.50. So you had about $1.20 a barrel that you caught to the downside. And I believe that actually this is a trade we took in the trading room, the reversal. This was 2 days ago, I think, or yesterday, because we got long here in the trading room off of a different trading strategy, and then we actually closed and reversed at the highs. But that's a story for a different time. This is the divergence. You had the divergence. It sold off all the way down, significantly undervalued. Right here, half profit comes off. Be satisfied with half profit at significantly undervalued. You just took around 60 ticks out, which is $600 a contract. I would probably be tempted to take full profit out and miss out on the rest of this trade, especially considering that I'm bullish crude oil. It ended up continuing on down. That's what the rest of your trade is for. You could have held it until you had the market stall again, which was right here. Your open and your close were right next to each other. This one you could have considered a stall, but they were a little bit further apart, the open and the close. This one they were much closer together, so you had a lot more indecision there, and your momentum histogram started ticking back to the upside, so you could have gone ahead and closed the rest of your position there. Now, how can we lower our risk on these trades? First and foremost, same rule as number one before, proper stop losses. Make sure you automatically have a stop loss placed. Make sure that you are paying attention. You don't want to get pulled away from your screen if you're scalping off a 1 or 2 minute chart, because you'll miss your opportunity to take profits or move your stop to break even. And again, what would have once been a profitable trade ends up being a losing trade. Number two, patience. Same thing. Like I said before, with trading, you're getting paid to be patient and wait for the proper opportunities. As I said, with that 5-minute chart, you only had, let's see, 1, 2, 3, 4 signals in a matter of almost 12 hours. So you have to be patient. Rule number 3, break even stops at the opposing value level. As I mentioned before, that's what takes your risk off the table and allows you to have what I consider a risk-free trade, which is you're not going to lose money unless the market gaps above your stop loss. Rule number 4, add a filter, meaning you're only trading in the direction of the trend, and I'll show you how to do that here in TradeStation in just a second. And what I normally use is MQ regression. The MQ regression works great for the trend of the market, for showing you just a generalized trend. I use a longer analysis period, normally around 100 bars, and if it's green, that means I'm looking to only buy bullish divergences. You'll have much less signals, but the signals that you do have and that you can trade will be a lot more successful. Rule number 5 is wait for the momentum to roll over. That means you're not getting in as soon as it hits the significantly under or overvalued price point. You're waiting until the momentum starts ticking down in the opposing direction. So it has started, your momentum histogram bars, you had one there. It's growing, growing, growing. Then you see it start rolling back over and getting lower. So as soon as you see it stop going up and start going down, you're shorting. As soon as this bar closes, you're shorting on the open of this bar. That way you know that the momentum has started to roll over, and that gives the trade, makes it official, an official divergence. Also, you can use the cycle finder and wait until your cycle finder starts ticking back towards an up cycle. And I'll show you how to do that with the NQ cycle finder as soon as we pull up TradeStation as well. Now, like I said, we'll go ahead and get started with TradeStation. Before we do that, just so I don't have to pull PowerPoint back up, just like I mentioned before, questions, we'll do a Q&A as soon as we're done with TradeStation. The live trading room is up and running. We've been doing extremely, extremely well. A lot of people are very, very happy. Everybody, most people in the trading room are making money. We've been on an 11-week winning streak, basically. We've had 3 down days in the past 11 weeks. So we're doing extremely well. And what we do with the live trading room is we explain why we're trading, what we're seeing happen, why we want to place a trade. And if you have questions, I'm more than happy to answer them throughout the day. Why did we take that trade? Why did we place our stop loss there? That sort of thing. But again, it's not like you're always going to win in trading. As I mentioned, we've been on a really good winning streak, but I'm not saying that we always do win. Signal Feed is also released. That's a great product. Signal Feed works extremely, extremely well. What it is, it's a desktop application and allows you to receive alerts whenever Mark or myself place a trade or see something developing. Kind of lets you look inside of our minds while we're not in the trading room. We're not showing you in a webinar, so you can see what we're following in the markets when we're trading either our personal accounts or other accounts that we have. So we'll go ahead and pull up TradeStation, and then we will continue on, and we'll look at some examples here. Crude oil. This is today on a 2-minute chart. All right, we had a few trade opportunities actually right here on our screen. The first one, we had a short here, and you had that bearish divergence. So we would have had a short right here because if you look at your indicator, lower high indicator, you're within a couple ticks. Actually, you had an equally high high or a higher high. So it's a great trade opportunity. As soon as you hit that same high, you can be looking to short, risking a tick or two beyond it. So you're only risking about 3 or 4 ticks on this. You're short. As soon as you hit undervalued, your break-even stop. That, or you're taking profits. Even if you just took profits at undervalued, you, in a matter of 2 minutes, went from 97.70 all the way down to undervalued at 97.54. So you 15 ticks in 2 minutes. It's $150 per contract. Normally, I try to trade 2 contracts at a time when I'm scalping like this. That way, I can take half profit. But either way, you either had a profitable trade or you got stopped out break even. The next trade opportunity was up here. You had higher high prices, either the significantly overvalued price bar there or the moderately overvalued price bars up here. You had lower high indicator readings as the market was rolling over. Higher high prices, you have the okay to go ahead and get short. You could have waited until the market stalled, which would have been right up here, and then gotten short in the fair value area with your stop 2 ticks beyond the high. The high was 97.82, so your stop would have been 97.84. Market rolled over. As soon as you hit undervalued, you move your stop to break even. Ended up continuing on down. So you're short from, call it 97.78. That's 4 ticks off the high. Again, you have to be quick. Technically, you want to be in at the overvalued price. So technically, you want to be in up at around 97.80. But we'll say you were a little bit slow, got in a little bit late, got in around 97.78. You hit significantly undervalued at 97.55. That's 23 ticks. So $230 a contract. Just a few minutes later, there goes half profit. The second half stays on with a break-even stop. It continued to roll over and fell all the way down until you had a bullish divergence right here. Then you're exiting your position and potentially reversing your position. So you're significantly undervalued. lower prices, higher low indicator line, higher low histogram. Technically, you could have been getting in at this significantly undervalued price bar there, although that's an equally low price. But that is around 97.28. The overall low was 97.24, so if you're risking 5 ticks, you would not have gotten stopped out with that quite yet. It ended up rolling over, rallying right back up, significantly overvalued. Again, another 10 or so ticks, so the upside that you took out. It ended up pulling back down and giving you a double bullish divergence, which is another great signal. What a double bullish divergence is when you come down lower prices, higher low indicator. Then you came back down, again, lower prices. You eclipsed the previous low by 2 or 3 ticks. The market stalled, higher low indicator, you get long. It ended up rallying straight up from there. So you would have gotten long on the open of this bar at 97.27. You hit significantly overvalued at 97.46. So 20 ticks to the upside for half profit and then break even stop. Then you had a bearish divergence right there. Higher prices, lower indicator high. You get short, risking 5 ticks, rolled it right back over. So your second half came off at plus about 30 ticks, and then you reverse position. It fell all the way from 97.60 area all the way down, significantly undervalued, 97.39. So 21 ticks to the downside, and then you could have held that, but you're really out of the main volume area. So I would have stopped trading after this when the market started just stalling out like this and not really moving much. And I never traded divergence. I never tried divergence trading when the market is gapping like this. That's what I'm talking about with a low volume market. I never ever trade when the market's gapping like that, because that can kill your divergence trades. We can go back and look even further for potential buying and selling opportunities. If you're trading with the regression line, if you're using the regression line as a filter, you're not going to have as many signals, like I said, but you will have a few. You would have had a buy signal right here. It came down within a few ticks of this previous low right there. Let's see, this low was 96.49. That low was 96.48. So you actually, you were 1 tick off of it. Again, you're risking 5 ticks. Higher low indicator, ended up rallying straight up from there. You could have caught that entire move to the upside. That really would have been the only good divergence trade you had, trading with regression. The rest of them weren't really great, but that would have been a great trade. You would have been in at around 96.53. You had your short signals at 97.71, so you're up $1.20 a barrel, which is $1,200 per contract. Not bad. You had a few bullish divergences back here. This is at 5 a.m., 5:30 a.m. Eastern time, a little bit after 5:45. Equally low prices, if I can get this to work. Equally low prices. Higher low indicator. You can see there's your higher low on both the indicator line and the histogram. Equally low prices here, moderately undervalued. The market stalled. You have the okay to go ahead and get long. As soon as it hits moderately overvalued, stop goes break even. Probably would have gotten stopped out break even, but this is that double bullish divergence. Came right back down within a couple ticks of the low with, again, higher low indicator, so you could have gotten long once more. Here, stop goes break even as soon as you hit overvalued, so you're in break even stop. It never hit your stop again. You could have caught the entire upside move here until you had the reversal signal for the short, and that would have again been all the way up at the high. So you would have been in at 96.33, and the high when you had your reversal, your short signal, was 97.70. So another huge move, about $1.40 per barrel. That's on a 2-minute chart. We'll take a look at some 1-minute charts really quick. By the way, there's a chart trader, and like I said, I'm on a sim account because I can't show actual account values for security reasons, or actual account numbers for security reasons. So I am logged in on a sim account, just so you know. Here you have a short signal, a bearish divergence, came all the way up. There's your first rally. Here's your second rally, significantly overvalued. Lower high indicators, you have the okay to go ahead and get short. If you wanted to be more conservative, you wait for the stall right there. That's also one of the candlestick reversal patterns that we trade. If you want to learn how those work, the candlestick reversals is probably my absolute favorite trading strategy, even more so than the divergence, scalping, and crude. Candlestick reversals, they work on all time frames, and they're just, the accuracy, it blows me away at how it works. It's incredible to me. But again, you stalled, so you would have gotten short on the open of this bar. 97.58. Stop goes at the high, so 97.62. 2 ticks beyond that, so you're risking 6 or 7 ticks, depending on how aggressive or conservative you are. Ended up rolling over all the way from 97.58 where you entered. You hit significantly undervalued at 97.43. So again, another 10 ticks or so. It only took a few minutes to happen. Here's your bullish divergence. Actually, that's not a bullish divergence. That was a bullish divergence on the 2-minute chart. So excuse me there. Here's a bullish divergence though. Right there, great bullish divergence. You can see it's actually a double bullish divergence. This would have been a good buy signal in my opinion as well. It came down, lower low prices, market stalled, higher low histogram. You would have gotten long with your stop at the low. Would have gotten stopped out, that's all right. You would have had another buy signal down here, lower low prices, higher low histogram once more, and now your indicator line has also stalled out and you have equally low indicator line. That's the even better signal like I mentioned. You get long, risking 5 ticks beyond the low, so the low's at 97.30, so you have your stop at 97.25. Right there, you never got hit, so you're long from 97.33 about, significantly overvalued is 97.48, so you got 15 ticks to the upside there. There's your bearish divergences. On a 1-minute chart, they're not as good. I'll be the first one to point that out. Your signal actually would have been that short. That would have been your short signal. Or this one, if you were extremely, extremely aggressive, you could have taken a short here as well. That's because you had your upsurge, and then your downswing, and then you're up again, significantly overvalued, and then the market stalled, and you had a lower high, so you're shorting, risking 5 ticks beyond the high, ended up rolling over. That would have been a great trade to the short, to the downside. Here's a buy, you had a long right here, lower low prices, higher low histogram. So you could have gotten long there. You can continue over here. Here's your short, just about the same high within 2 to 3 ticks. 97s or 27 is the high there. The high here is 31, so you're 4 ticks off. It's a pretty aggressive trade, but if you look at your momentum, the momentum has really moved down. So it looks really good for a short because the momentum has moved over quite a bit. And you're short from around 97.25, significantly undervalued, 96.95. So you took about 30 ticks out there. But you can see, you can get the idea of what I'm talking about. So what I'll do, I'll go ahead and show you how I get the automatic order placed, the automatic stop loss. What I look for is you go attach OSO. So you check that box right there. You change the number of contracts you're trading to however many you want to trade. You'll click on this drop down box. So it's attach one starts other. So it's a one starts other order. You're doing exit stop only. That means it's putting in a stop loss that will exit your position, and that's all it's going to do whenever you place a trade. And it'll do it opposing whatever you went. So if you went long, it'll put a sell stop. If you went short, it'll put a buy stop. So you do exit stop only. Then when you trade, you buy market or sell market. When I'm scalping like this, I always use market orders because you have to be very, very fast. That normally puts you in a tick or two below or at that high, depending on the liquidity. That's why you don't trade gappy markets like this, because when it's jumping like that, you'll buy one contract and it will jump 2, 3, 4 ticks. If you buy 2 contracts, God forbid, it'll jump 5 ticks. So I stay out of the gappy markets like this. So as soon as you place your order, it'll automatically place the trade for you, and it will put the stop loss in place, and that will be however far off you set it. The way you set this distance you want your stop loss off is you have this order entry screen pulled up at the top. The way you get that, you go to View, Order Bar. So you check the order bar so that's up. You will right click. You'll go to Order Entry Preferences. You'll go to Futures if that's what you're trading or whatever it is, equities, options, forex, etc. You'll go to Trading where it says one cancels other, one starts other settings. So OCO/OSO settings. You'll go to Preferences. You're in the Futures tab again. You want one starts other because you're using a one starts other order. You'll go all the way down to the bottom. Stop only. You'll format that and you'll set the number of ticks that you want it off. 10 ticks, 9, 8, 7, whatever you want to automatically set your stop loss at. I normally use 10 tick stop loss, and then once it's on your screen, once you've placed the order and it's on the screen, then you can click on the stop loss. It'll be a line. You can click on it and drag it to whatever place you want it. All right, so that covers how to do that. What we'll do, we'll go through and answer some questions really quick, and then we'll end today's webinar. I know we went a little longer than normal. I normally try to keep these webinars only about 30 minutes long because I know people have a lot of things to do and don't want to respect your time. So we'll go ahead and answer some questions and then conclude the webinar. Are there previous webinars that are archived? I believe so. If you go to valuecharts.com and you look at the videos section, there should be archived webinars there. Should you go to the next higher time frame to see if you can catch a longer move? Like I said, when you're scalping, it's all right to have your outlook. Okay, so crude oil, we've been bullish. We've been saying crude's going to head higher now for 2 weeks, ever since it broke the weekly trend line. So you know what your outlook is. Your outlook is bullish. So if you want to try to hold it longer term, you can. But if you're scalping off of a 1 minute chart, then your profit targets are 1 minute profit targets. So your profit target is going to be significantly undervalued on a 1 minute chart. So also, you don't really want to take your eye off the 1 minute charts when you're scalping because it'll spike and it can run your stop, or it can pay attention to your trades is what I'm trying to say, because you really got to watch, especially on 1 minute basis when you're trading in very high volume time frames, because you can see in 1 minute there it went from the high was 73 and the low was 56. So you had a 20 tick move almost in 1 minute. That's what I mean by you have to be paying attention, because the market can move a lot. That's $200 a contract. Are the MQ momentum and the value charts indicators similar, i.e. giving similar signals? No. Value bars are showing value. Value charts are showing value. MQ momentum is something completely different. It has nothing to do with value. It's showing the market's momentum. It's a different indicator than market design. They have nothing to do with each other. Can I show both indicators at the same time to show you similarities? You mean value bars and value charts? Dan, is that what you're talking about? Value bars and value charts will be the exact same as long as you have your analysis period set the exact same. In the sell, I said I risked 5 ticks. In the buy, I said I risked a couple ticks. Yeah, saying a couple or a few is a habit. As I mentioned, I try not to risk more than $200 a contract at any time. And normally when I'm trading divergences, I'm risking between 5 to 10 ticks. You can use closer stops if you're right against a support or resistance level. Another thing you can do is if the market moves in your direction, gaps in your direction, or it really starts moving the way that you want it to, instead of leaving your stop loss off 10 ticks or off 5 ticks where you're risking 50 dollars a contract, move it a little bit closer, move it within a tick of the high or something. That way you're only risking $20 a contract. So if it does end up being a losing trade and it does come back up, then you're getting stopped out at a $20 loss per contract instead of a $50 loss per contract. Sorry, a lot of questions. You assume the red and blue arrows were added for illustration purposes. That is correct. The indicator does, none of the indicators put the arrows there. I'm putting them up there so you can see what I'm doing. Another thing you can do as well, and this actually probably would help a lot, you can see right now value charts are getting lots of over and undervalued prices all the time. The reason is I have value charts set to a 5-bar analysis period. If you format your value bars or your value charts, they're accurate between 5 and 50. The most I'll normally ever use is 21, but when the market's really choppy like this, you can try using a 10-bar analysis period. It kind of smooths things out a little bit. You can see these highs and lows are no longer over and undervalued. It does a much better job of identifying the extreme value levels. So you can change that to a 5, from a 5-bar analysis to a 10 or a 14-bar. I think the default setting is 14-bar analysis. Normally in the trading room we use a 5 because we want as many signals as possible. But that's a much more aggressive approach. This is knowing what the bars look like after the divergences. At the time that the bar is forming, you do not know if it's going to continue. You're correct, Nishran. That's why I said the conservative way to trade it is to wait until your momentum starts ticking back over. For example, this long here where you had the bullish divergence, you had lower prices than the previous low, but you had a higher indicator. It didn't actually start ticking up until this bar right there. So you would have bought at the close of this bar. So you didn't get in at the low. You would have got in at the open of this bar and then risked the low. So the more conservative thing to do is to wait until the divergence is what I called official, which means it started to roll back over. Then you have the okay to buy or sell if you're shorting. Yeah, you have to remember your risk and reward ratios are basically the same, but you're going to have more signals on 1 and 2 minute charts than you will on 5-minute charts. My favorite is 2-minute charts. 1-minute charts are fun just because it's nonstop action. Your trades are lasting 5-10 minutes at a time, very quick. What I have dropped the long with significantly overvalued. Depends. I'm not sure. I didn't take the trade personally. It really depends on how I feel at the time. If I see the momentum really start taking off to the upside and I see it hit significantly overvalued, like I said, I'll almost always take half profit. I try to leave the second half one longer term. I do get impatient a lot of times though and take profits too soon. As you know, if you're in the trading room, a lot of you have caught much bigger moves than I did because I took profits much too soon. My main trigger time frame, 2 minutes. That's my favorite one to trade. I think the signals are the best there. Also, what you can look for, even if you're looking for divergences, the other way you can trade it, this is just another scalping method. That's again using the value candlestick reversals, which you had a reversal candle here, you had a reversal candle here, you had a downside reversal candle there. You have a lot more trade opportunities when you're trading the candlestick reversals, and like I said, it's scary how accurate they are. They work extremely, extremely well, and it's one of my favorite ways to trade. And you can use them. I trade them all the time. Here's a perfect example, actually, of a reversal candle on a daily chart, and I missed this until the Australian dollar had already rallied. That's one of the reversal candles that we trade and that we're going to be talking about in the candlestick reversal course next week. Great, it's a textbook signal right there. Ended up rallying right up from the trade. Very profitable trade if you had taken it. There's another one. The Australian dollar has a lot of them. Actually, it follows the candlesticks pretty well. There's an upside reversal. There's a downside reversal. So again, if you want to know how to learn really in depth and be able to do that on your own very, very well, we have the reversal course next week. And you can sign up for it at valuecharts.com. Do I use 5-tick stops on 1, 2 minute, and 5 minute charts? In between 5 and 10. It depends. If I'm on a support level, meaning I'm right up against a previous low or previous high and it's the divergence that I'm trading, then I'll put my stop just 2 or 3 ticks beyond that high. So it lets it try to poke above or below that high and then knock the stops out and then run in my direction. Is my first target area significantly overvalued or moderately overvalued? First target area for half profit is significantly overvalued. Moderately overvalued means I move my stop to break even. What's the significance of the plus 25 and minus 25 levels on the MQ momentum? That's just basically showing the extremes. It's more likely to roll over when it's in those extreme levels. I don't really pay attention to them, honestly. I trade off of the divergences. Are both the fast and the slow lines on the momentum equally important? Yes. How do you filter using the cycle finder? Let me insert MQ cycle finder and I will show you. All right, what the cycle finder does, an up or a green bar means up cycle. Red bar means down cycle. So you're looking for the divergence. Let's see, we had the divergence up here at the highs. So instead of waiting for the momentum to actually tick over to the opposite direction, let's see, you can use, a lot of times you'll have the cycle finder will alert you a little bit sooner. So for this example, for the long, it would have been the exact same because the cycle finder ticked over at the same time that the momentum did. As soon as it ticked up, that means the up cycle should be starting. It gives you the okay to buy. On the upside, as soon as the cycle finder ticks down, it gives you the okay to sell. So here, it would have given you the okay to sell on that bar using the cycle finder. So it plots cycles. You can also use the cycle finder alongside momentum looking for divergences, because a lot of times you'll find the same divergences on the cycle finder and the momentum, and when it's on both of them at the same time, it's an even better signal there. Can I pull up value charts as an indicator down below? Yes, I can. The only time, honestly, that I really use value charts themselves, you can find some really great divergence trades on value charts where a market will, and again, you have to adjust and make sure your analysis period is the same for both so that they line up. But you can see overvalued right there is overvalued right here. Significantly undervalued right there is significantly undervalued on the value chart as well. But you can find divergences in price and value where a market will hit. Here's this top one's a great example. Here was your first rally right here. You went all the way up and significantly overvalued. Here's your second rally. You hit high prices, but your value only went up into moderately overvalued, so it didn't have the strength that it had before. And then the third one, you went all the way up and you just barely touched up into moderately overvalued. Most of it was in fair value. So it lost a lot of the momentum, the strength there based off the value divergence. So you can trade that way using value charts as well, looking for value divergences. But I normally use value charts with my candlestick charts for all my candlestick reversals. I use open, high, low, close charts and value bars for most of my divergence trades. Do I have a template for NinjaTrader? I do not have a, I'm not sure what you mean by a template, I guess. The indicators work the exact same. The cycle finder, the momentum, they're both set to default. My value bar setting was set to 5-bar analysis, and my trend line or my regression line is set to a 100-bar length. Would I trade crude oil for the FOMC? Normally during news announcements we try to get flat unless we're significantly in the money, and then we have a break-even stop. Just because markets can go crazy and you don't want to get stuck in a limit move. My entries and exits, both via market orders. Yes, that's the fastest way to get in and out with a market order. I cannot tell you how many times people have tried trading divergences and they missed them because they said, as I said, it only pokes into these specific levels a very, very small amount of time. And people, I know many different traders that have tried placing limit orders, and they'll miss the opportunity because it'll never hit their limit order. Candlestick plus value bars, or just candlestick reversal? I'm not sure what you mean. What analysis period do I set for value charts? 99.9% of the time I have a five bar analysis period for value charts. The reason I have that is because you get more signals than you would otherwise. You just have to be aware of that. When you're in really choppy markets like this, though, like I said, it actually is probably more prudent to change it to a 10 bar or 14 bar analysis because you'll be much more accurate with finding under and overvalued prices. Yes, there is a cycle finder for NinjaTrader. It should be in the value charts large bundle. All the indicators are available in both NinjaTrader and TradeStation and Bloomberg and multi-charts. Value charts do look a little bit different on NinjaTrader. Actually, I think they look better on NinjaTrader in my opinion. All right, well, that concludes today's webinar. It's been about an hour and 15 minutes, a little bit longer than we normally try to go. Like I said, we normally try to keep it around 30 minutes. I want to thank everybody for coming. Hope you enjoyed it. Hope you learned a little bit about how I trade divergences, how I trade these quick scalps in crude. Like I said, it's one of my favorite ways to trade. It's very fast-paced, very quick, in and out. A lot of fun in my opinion. So hope everybody has a great rest of the night. And for everybody that's in the live trading room, I will see you tomorrow, and we'll try to trade some of these divergences. We'll see what happens. So again, have a great night. Thanks for coming. See everyone in the trading room tomorrow.